Okay, we're gonna, do these work? Yes? No? We're gonna get started with our next panel on putting steward ownership into practice. We've got three great panelists. So Gigi Danzinger is here from Utopia. We've got Christian Kroll from Ecosia and Juho Makonnen from ShareTribe. Juho and Christian are gonna call in, so I think we have them on screen, right?
Hi there.
Hey there, we're just getting your video up. Okay, perfect. So I thought we could start out with just all three of you giving a little bit on your background and what steward ownership means to you. Maybe Gigi, we can start with you.
Sure. Does this work?
It doesn't seem to work. Let's see. But you can take mine.
So hi there, I am Gigi Danziger, and I am the founder, together with Albert here, of Utopia. And what we do is we're working on innovative models for other investors, donors, and communities around the world. We are working on a number of initiatives in upstate New York, in the city of Hudson and surrounding areas. That includes such models as a basic income pilot. We're actually the first small city basic income pilot in the US. We have a climate action farm, we have a community learning hub, and we have a 50s diner, a good old-fashioned 50s diner. We've also invested in probably over 100 investments that have what I like to call underappreciated founders and funders. We are really interested in the steward ownership model. We are in the process of implementing it over a number of our initiatives, including affordable housing and farming and restaurants.
Perfect. Could we get both of these working, or should we switch back and forth? So Christian, why don't we go to you? You could tell us, Christian, a little bit about yourself and what steward ownership means to you.
Yep. Hi, my name is Christian. I'm the founder of Ecosia, which is a search engine that uses 100% of profits to fund different climate projects, especially tree planting projects. We have, thanks to our millions of users, we've planted over 220 million trees so far. I started the company in 2009, so 15 years ago, with the promise that I would never sell the company and never extract any profits. But initially it was basically just a normal startup, so a normal LLC basically. But then in 2018, because the public, as we were growing more and more, the public and also some of our employees asked us to find a more legally binding solution to the promise that we would not sell the company. And then that's when we converted Ecosia into a steward-owned company. So in our situation, basically giving away 99% of the capital shares to a foundation and making sure that the big tech players couldn't buy us even if they wanted to, and making sure that we stay true to our mission.
Thanks for that overview. We'll go into more detail on it, but Juho, just quickly, can you tell us a little bit about your story and what steward ownership means to you?
Yeah, sure. So I'm the co-founder and the CEO of ShareTribe. So our software helps entrepreneurs to build online marketplaces. So with our software solution, you could build a platform that is a bit like Airbnb or Uber or Etsy. So our mission is really that instead of giving all the power to just like a handful of platform giants, we hope to empower like a large pool of smaller, more locally owned platforms where also the value would go back to the local ecosystems. So today we have a bit more than 1,000 platforms using our software. And just like Ecosia, we started with the traditional startup structure, but then also at some point people started asking us that, hey, okay, if you want to take the power out of the platform giants, what if you end up becoming the next extractive giant yourself? And like at the time, we didn't have a good answer. We also had initially some like venture capital investors, and then at some point we started realizing that, okay, we don't really ever want to sell the company. We want to ensure that it will always remain mission driven, and that's also like when we found steward ownership, and like Ecosia in 2018, we converted to that. We raised a crowdfunding round and bought back some shares from our VC investors to allow us to convert. So for us, it really meant making this kind of like a binding promise to all our stakeholders that we won't sell out.
Cool, that's great. I mean, it's great to have a couple of operators and also an investor on the panel. I think I'm probably the most jaded person in this room, despite my rhetoric. And the question I have is I've been a software entrepreneur for a while, and it's super hard to be a software entrepreneur. And there's two things about your models, Juho and Christian, that I found interesting, which are you've given up governance, and you've also, Juho, created an interesting model to figure out how to incentivize founders and employees while also moving to a shared ownership model. And in my own experience, anyone who's been in business for long enough is going to get burned. And the easiest way to get burned in an early stage startup is governance, and getting governance wrong. And I can't imagine going through the pain of building software without the upside at the end. It's just, to me, and maybe I'm too selfish of a person, but I couldn't put in the hours, it just wouldn't be worth it to me. And so the way you've structured your ventures is really interesting to me, because you are either better human beings than me, or you have figured out something that I've not yet been able to figure out. And so maybe, Juho, we could start with you, and you could talk a little bit about how you valued the early effort of the founders and employees, and then thought about how to cap that so that you got the upside, but also kind of baked into the organizational DNA this shared ownership model.
Yeah, definitely. Maybe I can start just quickly about the motivation, as you mentioned that. So I think that I feel that for every entrepreneur, it's very important to ask, what is the thing that you really want out of life? And we noticed actually that one of the things that we really wanted with my co-founder was to build the best possible workplace for ourselves. So one that we would still enjoy coming to work every day 10 years or 20 years from now. And a big part of that was really creating this environment where we are actually in the control of our own destiny instead of being controlled by outside shareholders. And so from that perspective, actually, this transition was also something that made our lives a lot better. And indeed, it did cap the upside, but we did also feel that it's fair for early founders and early employees should get compensated for the risks that they are taking, because often they are early, they might be completely without salary for a period of time, or they might be accepting a lower salary in the beginning. And in a traditional company, this is usually compensated by options, but those options really are worth anything if the company doesn't exit in the form of going public or company sale. As we didn't have that, we instead came up with a model of delayed compensation, where basically we, for us founders, we calculated exactly how what was the amount of money that we lost in a way by not accepting a job that would pay a regular typical average salary with our education over the years. And then we use the same multiplier for the interest that we use for our investors. Because we have this model that when somebody invests in the company, then the company will eventually buy it back. Our goal is that in 10 years we buy the shares back for 5x profit, and so we applied the same multiplier for ourselves. Then we ended up with a figure that is for both me and Antti between 1 and 2 million euros. That is the maximum compensation that we can eventually get from the company's profits. So we felt that is if we ever end up getting that we feel that we are quite wealthy at that point. But we also felt that there's such a thing that's enough compensation, and we think that compensation is enough for the effort and risk we put in.
Okay, interesting. And so just to push on that a little bit, you're not there yet, so we don't know yet. We don't have the definitive results if you're going to continue for 10 years after that and be motivated once you hit that threshold, right?
Exactly. So the structure works so that the team founders will be the last ones to get the compensation. So we raised a crowdfunding round with this model, and people invested more than 1 million. And one thing we have in the model is that the investors kind of need to get their own back first, and then in the end, the founders and employees will also get theirs. So indeed, we still have some profit to generate to be able to make those paybacks, but hopefully they will happen on schedule.
And have you found that you've been able to compete for talent? I mean, when I think of software venture, I think of a lot of upfront R&D costs. I think of the need to move quickly. I mean, I know you're working in SaaS, but I also know in the marketplace space, you've got other players like Miracle and others that you might have to contend with, and I know you've got some differentiators there. But how have you carved out this niche and been able to compete while also not getting significant access to venture capital or risk capital?
Yeah, I think the key word there is that you need to then be making profit, and then so that you are able to pay people well. So I think there are two things. One is that I do think that people then should be getting a fair compensation immediately instead of waiting for the future promise, because there's no promise for the future exit. The other is that at least our experience has been that many people have been excited to join our company even though they would be getting a higher salary in other companies, because they want to associate themselves with a company that exists because of a mission where they can really feel that, okay, I'm doing something that is for sure beneficial for the world, and not ends up being just extracting all the value to make a couple of people really rich. Obviously, different people have different motivational factors, but at least our experience is that it's possible to find people who are heavily motivated by that, and that those people will be happy to join a company like ours, and that's actually a great differentiation for us.
Thanks, Joe. And Christian, can you walk us through kind of your journey to this governance model that you have now? Equally uncomfortable for me, but also inspiring. And so it'd be helpful to hear, when in the organizational's history you did that, why you did it, how you structured it, what are the legal implications? Just walk us through the whole case study.
Yeah, I mean, you mentioned that you couldn't imagine going through all this headache. For me, this was no headache at all. Actually, I couldn't imagine having to deal with investors and the board and a lot of people annoying me and trying to push me in a direction that I don't want. So I'm actually super happy. So in terms of our own company history, so I think the great advantage that we had was that I bootstrapped the company and didn't take on any investor money. And that made it a lot easier. So a few years later, then I also had my business partner joining. He got a few shares as well, but he was also on board with this conversion of the company into a steward-owned company eventually. So if you have people who are on board like this, then it's actually relatively easy. The real pain starts if you have people who are not on board. If you need to buy out an investor for ridiculous amounts of money, then this can even become impossible. In our case, it was basically just Tim and myself agreeing that we would do this. And this was for us more like almost like a natural consequence of what we were doing. I mean, we said we will always give 100% of our profits to solving the climate crisis. Why not make that legally binding, that promise? So it was really just making, also helping our users to be really able to trust in what we're doing, and also the public to trust in what we're doing. So then, I mean, it was still a little bit of a small hesitation because a search engine that generates many millions in profits every month is worth a lot of money, hundreds of millions, if not more. So there was a little bit of a hesitation on my side to also reflect, I also asked myself, would be nice to have a lot of money in the bank account, but I realized, what would I do with that money? And that would be, I would use everything that I can or do everything that I can to solve the climate crisis. And then I realized, that I can do with my company. That's the mission of my company. Why should I sell my company in order to achieve that? And I felt like the biggest statement that I could do with my own life was basically to do that conversion, to give up my rights to have for a big exit, but to make sure that this movement, we're not only a search engine, we're trying to be a lighthouse for a regenerative economy where companies really do everything they can to solve the climate crisis. And I hope we will be more and more successful over time so that especially other big tech companies are also forced to do more of the same, because then we could solve a lot of the issues that we currently have. So for us, this was really rather smoothly. I think the main obstacle that we faced was that once we decided that we wanted to convert and actually have something legally binding, we didn't find a fitting legal structure in Germany. So even now, there is no real legal structure. So we had to find kind of a hack where we're working together with a purpose foundation, which is basically in Germany like a service provider. You can give them all your shares and they guarantee that they will never return or never sell them to anybody, and always make sure that no profits can be extracted. So that was a little bit, that was a solution, but it's from various angles. It's sometimes journalists don't understand it, the public doesn't understand it, also the tax office doesn't understand it well. So that's a little bit of a pain. But other than that, it was really, for us, it was easy, because it was just actually implementing what we promised from the very beginning. I think there's also, because I studied business administration, so people say you will lose your motivation if it's not about like your own shareholder value anymore. This was many years ago. I haven't lost my motivation since. So it's really about making the company successful as I can, because I want us to have the maximum impact on solving the climate crisis. And I'm also earning a salary, right? So we're earning market salaries. That's not, I mean, of course I could earn more, but I can live comfortably with that. And that's all I need. I need some basic security and a meaningful and impactful life. That makes me happy.
That's great. And for me, it's a really inspiring story. Quickly, before we shift gears to kind of the investor angle, can you talk a little bit about your interaction with Purpose Foundation? Because you've brought them on effectively as what we would think of as a trustee almost. And did you do that because they were the first in the market, because they had the biggest kind of brand identity, because you connected with them? And what's the interaction with them on a from a governance perspective on a day-by-day basis? How does it work?
Yeah. So actually, when we were thinking about taking that step to turn it into something more legally binding, we've been talking to lawyers. We paid a lot of legal fees and didn't get good results from that. And then it was actually one of our employees who found an article in a magazine that was talking about this topic, and another small company, I think in the organic food space, who basically was facing the same challenges as we were facing. And they basically started this foundation. So in the beginning, it was, I think, 1 or 2 companies who were joining forces. And we started talking to them and realized, okay, they really understand what we want to do. And then together with them, we were still one of the early companies, and there were a few hiccups, but by now, I think this is all much easier. I think also because of the size that we have, and I mean, we have millions of users, and also educating those users about the ownership model that we have. Now this is actually much more visible. So if you're studying business now at a university in Germany, then many universities also teach that model and use us as a role model, or other similar companies. So now I think this is much easier to do than it was still a few years ago. And the way this works, I think basically we almost, like, we wouldn't have to interact with them at all. We're meeting quite frequently because they're nice people, but basically all they need to do is sign your annual report and basically confirm that you're not paying any dividends and sticking to your company mission. And they would always make sure that the company could never be sold, or never any dividends could be extracted. And then you're paying them a small fee for that. So that's basically, that's all it is. Or me and my business partner, we still have 100% of the voting rights. We're still managing the company as entrepreneurs. We're taking risks. We're not an NGO. We are a startup that is trying to win against Google. So it's not like this doesn't mean that we extract, just because we basically remove the capital rights from the company. This doesn't mean that we gave up ambition. No, the contrary. And But I think in principle, the model is very flexible. You could do many types of implementations. They just need to make sure you can't sell the company, you can't extract any profits. I think that's the same for you, Juho, right?
Yeah, very similar. Like in our case, like we actually gave Purpose Foundation only exactly one share, but we have a model where we have in our articles of association that there are some decisions in the company that would need to have 100% of the voting shares behind them. So basically, the only role of the steward, the Purpose Foundation, is really to prevent us from dismantling the structure. So it would have to veto things like if you would suddenly want to sell the voting shares or start extracting the profit and so on. So it's really, but other than that, they don't really participate in the governance. We are very self-managed. 100% of, or like 99 point something percent of the voting power is controlled by people working at ShareTribe. So the decision making really happens within our team.
I want to take issue with. Is this working?
I don't think so. Here we go. Sorry about that.
I want to take issue with investors necessarily being annoying, Christian. Because in our world, what
they can be, I think. I heard from other founders, I don't know, but yes, of course. Normally they're helpful, but there can be cases where they're not.
So in our world, what we're doing as investors is voluntarily giving up control and power to the stewards, And the way that works, for instance, is in the affordable housing arena, we can't, for instance, sell or mortgage a house out from under the folks who are living there, the stewards. Something really interesting about what's going on in the world today, which is that there's about $70 trillion that's passing hands first to the surviving wives and then the next generation. And that next generation isn't interested in using their capital for extractive means like fossil fuels or charging the highest rents possible. What we and they are looking at is how do we make our capital enabling and not extractive. And so this is what the steward ownership model really does. We also have built into our agreements a golden share, which I think is similar, sounds similar to what you have, which is a share that's held by a not-for-profit. And that means that if there's a huge decision to make, like the sale of a building, and let's say there's a big developer that comes and wants to buy out all the stewards and investors and wants to build huge condominiums charging the highest rent possible. Well, if the mission, which our mission in this case is to keep rents affordable, then that golden share held by a not-for-profit that holds that same mission can stop that action. So we've also built in safeguards ourselves.
Interesting. And so it seems to me that one of the, when I was much younger, I used to play a lot of poker, and there was this concept of table stakes. And one of the table stakes kind of these models is that you almost bake into the organizational DNA, either as an investor or as an entrepreneur, that you're almost fighting against your own worst instincts, right? So, this property isn't growing fast enough, so I'm going to, push the mortgage or to a secondary market, or I'm going to sell the property. But in your model, the stewards have this kind of control over that decision. And similarly, in the software model, you folks are saying, look, we need to ensure that there's this right to block exit, right? Which would actually normally be conceded in a significant venture round to the VCs, right? Unless there was some threshold hit, or normally you would have some sort of, minimum threshold on exit that would need to be hit. And that makes a lot of sense to me, just thinking through my own instincts and my own concerns, and fighting against your own worst self, in terms of making sure that the organization that you're building is actually truly protecting, from a legal perspective, what you're saying the mission should be, but also, Christian, in your example, allowing you to operate, and the fact that you have complete control. Because I think, in my experience with cooperatives, it's really challenging. The one member, one vote model is a really, really challenging model. I think, the cooperative started 150 years ago, or, really started on pirate ships, much before that. And so, it's a great model, but we need to move beyond it. Can you talk a little bit, Gigi, just about some of the things that you've learned as an investor in the education process of the stewards and some of the challenges that you faced as an investor?
Yeah, sure. So what I've learned is that trust, and I think one of you alluded to this earlier, is so important in order to make this work. You know, there's been traditionally a real challenge between, say, landlords and tenants, and they're on opposite sides of the table. And I think, you know, one of the things that we realized is if we don't have trust with the stewards, then this isn't going to work. You know, we've spent quite a bit of time working together with the stewards to craft agreements that we're all comfortable with. What's interesting is that in the case of the affordable housing, that people's ambition, and rightfully so, mine too, was always to own a house, say, outright, right? To have one's name on the deed. And but what happens is, more often than not, people have to take out mortgages and loans from the bank, which means that if they don't pay their mortgage payments, the bank can foreclose on them. And so actually, part of, as you talk about the education, is really understanding for ourselves and for the stewards that the steward ownership model is actually more secure for the stewards than them owning a house that has a bank loan attached to it.
I'm reminded of like David Graeber and 5,000 Years of Debt, and how debt is kind of the basis of so many of our interactions in society versus what I was taught at Chicago, that everything is based on utilitarian economics. The question that I kind of have is, you know, as people go into this model and they're playing around with it, and even for my own gratification, I'd love to know, what are some things, what was like the number one thing that was surprising to you or unexpected in doing this? Could be a good thing, could be a bad thing that you really only could figure out by doing it. Maybe Juho, we can start with you.
Yeah, so we were around 15 people when we made the transition. At that point, the company was majority controlled by me and my co-founder, and so this was very heavily our decision, and we did discuss this with the team, but naturally it was really interesting to see like what will the reaction ultimately be. Will people leave? Like, will they be unhappy? And that definitely there were some people who had some concerns, and we had some really good discussions, and we decided to push through nevertheless. In the end, nobody left because of this transition, and those people who had those worries came back to us like 6 months later and said, yes, now I understand this thing, like this is so great. So that definitely, it was like a big leap to the unknown, in the sense that like we were not really like sure, like how, like we had a pretty special situation because we were not in a lucky position that Christian had, being that we had not been able to bootstrap the company. We had to raise some funding to get the business going, which means that we had some venture investors, and they did not like the model. The problem obviously for them was that their funds were structured so that they really need the big exit that has like 100x instead of 5x. So then we ended up buying them out. And like, so because of that, when we started the transition process, we agreed with them that, okay, we need to raise enough money with this approach, with this crowdfunding model. And if we fail in that crowdfunding campaign, then we have to cancel our transition. So we have told to the world that we are going to be doing this. And then after then we do this campaign, and if that campaign fails, we because we are not able to raise enough money with this new model, then we have to take it all back and be a regular company again. And so that would have been devastating. And so that was one of the scariest moments of my life, and the biggest, I feel, some of the biggest risks that we took when we went public with that thing. And luckily the campaign turned out well, so we were able to complete that transition. But that was definitely something where we were not sure yet at the point where we started the process of would that actually work out, but it did. But maybe after that, what has been maybe the most surprising is that it hasn't really brought in any challenges for us so far. Though naturally it could be different if we suddenly would realize that we would need to raise a huge amount of capital But anyway, like our goal right now is just to grow organically and like with our revenues and just be profitable. So we haven't really needed to do that, but it could be different. That could potentially be a challenge because there are not so many investors who really understand this model.
Interesting. Christian, Gigi?
Yeah, so I think, for me, what I learned in the past years is that people should be in the very early days of starting a company, you need to be very clear which model you want to follow. Because if you managed to kind of turn this around, but if you want to go the steward ownership route, then you and your co-founders and also your potential investors need to be very clear about that. You can still promise like high returns to your investors. There's no problem with that, but it needs to be clear that this is going to be the goal. I've seen a lot of companies who kind of realized that a little bit late, and then it was impossible for them to still go in that direction, and that basically led to big conflicts and also people leaving the company, founding teams basically becoming completely dysfunctional, and that's a shame. And I'm not saying that the steward ownership model is the only model. We helped launch a big venture capital fund that is investing into climate tech. That is now the World Fund. It's Europe's leading climate tech VC with over 300 million in capital, and they are doing classical exit-focused investments in high-risk startups. And so I'm flexible, and so I want to solve the climate crisis. I'm flexible in how exactly we do that. It can be a VC-driven approach. It can be, in our case, I think it fits better to have the steward ownership approach. But for me, being aware at the very, very early phase of a company what direction you want to go can really solve a lot of problems, and just also highlights what motivations people have. If usually you have a few people coming together saying, yeah, let's start this company, and then they just assume that everybody has the same intentions. But sometimes there are people who just want to start a company because they want to make a lot of money. There are other people who don't care about money and they just want to solve an important problem. And it's important that you discuss this in the early stages and agree on something. Otherwise, there will be conflicts anyhow. And I think the nice thing about steward ownership and also this kind of honest conversations that you then need to have with investors, that you can tell them, I think I can't promise you 100x, but I'm fine with a 10x or 5x return. That is a much better and more educated discussion than the usual promises of, the sky is the limit. So I think this model is probably, I would say, more sustainable, but it's not so easy to get things off the ground extremely quickly and then just see if something flies or doesn't. So it's more for building actually lasting businesses, this model, in my opinion.
Great. Thanks, Christian. And Gigi, last remarks before we open it up to questions.
Yeah, so I think what has been a really fascinating journey in getting the documents drafted by the attorneys and talking to our financial advisors is this disbelief that we would actually want to voluntarily give up power that normally accrues to investors. They're constantly challenging, why would you want to limit your right to sell or mortgage the house? Why would you want the folks who live there to have to agree to it? It's been a real challenge because they just can't fathom that, we think that in order to make the world a more equitable place, that giving up power is the way to go.
Awesome. So Christian's comments on intentionality, Juho's comments on getting the right people on the bus after you figure out, what the mission is going to be, and maybe, Gigi, your comments on polycentrism and more of the Elinor Ostrom multiple foci of control are these three kind of elements of steward ownership that are really important. So we can open it up for one or two questions if there are some before the networking break. So let's start. Oh, I have two mics. Okay.
Thank you all. Christian, you can't see me. It's Michael Barnes here. But kudos on your decision, and you're saving a lot of money for climate by not spilling excess into taxes and intermediaries if you were to put that in your account and then try to reroute it. But Gigi, I think you probably may be an exception to the investor category that also proves Christian's general rule a bit. One question for you. What keeps you up at night? You make it sound really simple and resolved. What are the challenges you're facing? And maybe is scale a challenge, thinking about transitioning from smaller funds to sort of multi-billion-dollar institutional funds in affordable housing? What are some of the things that you think about?
So what we're doing is we're working on a very small scale, and so the idea here is to create sort of a model that can be replicated by others. So the hope is that as we kind of roll out the steward ownership model, we're going to make everything open sourced, and talking to places like here and talking to bigger funds and institutions, which we've started to do, and surprisingly they have been interested in this kind of model. So I think it's really just making it more common, or at least showing that it could be done, and sharing what our challenges have been and also what hopefully our success stories will be.
Maybe one more. Alan?
Thank you all. That was a really great panel. So you could take any successful company and say, we're gonna like clone X, but do something positive, right? So like X but eco-positive, or X but employee-owned, right? And often that's not enough to actually win in the marketplace. And so, especially to you, Christian, you've kind of achieved that dream, right? With like 3 million euros a month going to tree planting. So like, how do you think about customer acquisition?
Yeah, I mean, we don't even have 1% market share. I'm not sure if we already won the game. There's still a lot of potential. And I mean, I'm also sometimes a little bit jealous how some startups can just basically earn a lot of money on just ideas that we also have. And maybe we could move a bit faster, and also, if our user acquisition wouldn't have to be cash flow positive, we would also maybe be a bigger company by now. But then, I mean, where would that lead us? If eventually we had to pay somebody back, this means that the money, like some investors back, or a bank, if we had to return the money, then that would either mean that we give up independence, or that we just don't have the returns to the climate that we were hoping for initially. So I think it's maybe a bit more challenging. I wished I had many millions of on my bank account that I could spend without really having to prove that this is profitable. But I sometimes feel like we're building very strong roots. We're also not doing something crazy. I also like what you said, Juho, that you're building a sustainable business. I think in the long term this will pay out. I don't know what exactly. I mean, for example, now there's a lot of hype around AI. And I wished I could participate in some of those games. I see startups popping up that don't know more about that space than we do, but that are raising hundreds of millions. I would also like to have hundreds of millions on my bank account. But we're building something with a small team that I think might even be better what those companies are building. So let's see who wins in the end. I think money doesn't always win. Smart people who are really motivated can achieve a lot with a lot less money. And that also is true for user acquisition. So we have acquired most of our users because we've done things in different ways than just paying Google or Facebook for advertising. So I think having to do things on a smaller budget means that you just need to find more clever solutions. And the companies that find clever solutions, I think in the long terms have the right DNA to win in the competition.
I've also noticed that in general there's also like more of a trend in the VC world now, that there's more talk about companies that are staying smaller and like being profitable overall. Maybe also with the rise of AI there has been even more discussions. Okay, maybe soon we'll see one-person unicorn or like something like that. But I think that overall I'm also seeing this trend towards companies that are generating lots of value while actually staying pretty small and like being profitable. And I think that it naturally depends on the business that you are in. But I believe that also that definitely is like a false thinking that you always need to be really big in terms of team size, or like you need to make this huge investment upfront to generate value. There are many areas where actually like a relatively small committed team can make a really big difference and impact.
Gigi, final word. We've got this stopwatch here. It's stressing me out. I got 44 seconds for the.
My goodness. Well, just interesting note. So I was at a longevity conference a few weeks ago in Napa Valley, and this was called Truth in Medicine, a doc given by John Battelle, and Kevin Ryan was behind it. And there was a scientist that talked about the 2 leading factors that lead to a longer life. And can you guess what those 2 factors are? So it turns out that first is community, which we have here, and the second is purpose. So if steward ownership is not a reason necessarily to do steward ownership, but if there's a nice benefit to a longer life, then, well, I'll take it.
Awesome. Thanks. So we're out of time, so we have a networking break now. Juho, Christian, Gigi, thank you so much for your time and joining us.
Thank you.
Thank you.
That was great.